My guest today, and today is February 7th, 2023, is Howard Silverblatt. He is the senior index analyst of S&P Dow Jones Indices, more commonly known to most of us as the S&P 500. He's got about 3 decades or longer on Wall Street. He's got a lot of data, information, and statistics. He knows which industries fared well and which ones didn't fare so well last year. And he's got a pretty good idea of the conditions that might help some industries remain more buoyant and also others that might be subject to sinking. So we're going to use all of his wisdom in order to better inform our own portfolios, and we'll get started momentarily. Hi, Howard. It's nice to see you. It's been a couple years. How are things on Wall Street these days?
Uh, we'll know in a little while once Powell speaks, and of course tonight's Biden speech. However, Wall Street is somewhat empty now. A lot of the buildings have closed floors. It's a real estate situation. They've moved them to Midtown, but there's not too much downtown when you go. Even the wagons, the food wagons aren't there. So it's a real estate issue we may or may not get into.
Yeah, I really do want to get into that. But let's start off with your crystal ball. In general, I mean, I think that all of us were, not happy with the way stocks went last year, but also surprised that we didn't have an official recession. What do you see coming up for 2023?
I think we're off to a very optimistic start, whether it was fear of missing out or new flows coming in. We started off very nice at this point in time with a very optimistic investor. But I think we need to get a more of a grip on reality here, and that reality is earnings. While they're not coming in good, they're not as bad as was the whisper number on there. But we are selling for a very high PE at this point in time. And I just don't see the growth there at this level.
Right. So we talked a little bit then about maybe optimism, maybe newer investors that are not accustomed to the flows, ebbs and flows of Wall Street. Do you want to talk a little bit about that?
And I won't go through the Robin Hood situation that drew in my daughter and son, who had over 40. She had over 40 stocks at one point. I don't know an analyst that covers 40 stocks. Anyway,
Right.
yes, we are seeing people in there who have not seen down markets that much. Yes, there was last year, which was very difficult across the board itself.
Yeah.
However, they haven't seen massive changes. You go back 4, 5, 10 years, even the market has done very well. And it was the place to be, generally in stocks, not all
Yeah.
sectors, but overall. So we do see a lot more optimism, and the belief still is that you have to be in the market on the long term. The difficulty here is that there appears to be more timers in there. We're not talking professional, we're talking on an individual basis
Hmm.
who attempt to time the market. And there's an old saying, bulls make money, bears make money, pigs get slaughtered. And timing the market is probably one of the hardest things to do.
Yeah, that's interesting. You know, we definitely want to stick into real estate, but I want to start off with the industries that didn't do as well last year and what you see going forward. We definitely saw that NASDAQ was a great deal weaker than the Dow Jones Industrial Average last year. So what is it that you say about technology, biotechnology, some of the things that really sank last year? Going forward, and then also things that might be a little bit weaker this year than were more buoyant last year.
Well, being that this year all the situations are so totally different, yet we're seeing the old situation return where those that did the worst last year have opened up this year the best, the rebounders.
Yeah.
And we're seeing that in general. You're seeing it in the communication services, in discretionary, in IT, and they've done very well this year to date in the mid-teens. But if you take that chart back to last year, you
Yes.
still see deep red numbers. Again, I'll have to go back to the earnings that I still think we're not justified in the PE that we're paying. Some of the groups, however, do have good earnings. Energy, which did very well last year. The earnings are expected to decline, but still represent about, for example, this quarter, 10% of the S&P 500. This sector is only 5%. They are
Right.
contributing a lot more. So yes, the numbers are going down. We see the reverse somewhat for IT, where it looks like they're taking have more pressure on the downward side for information technology, not just chips, but across the board with selling, whether it be something like an Apple or a Dell computer situations. But those are expected to get better as we go beyond the first half into the second half. Again, the second half is a lot rosier, and that's what's helping to support the market at this point. When we read all the guidance that we've gotten, from the fourth quarter, it's very down, expecting recessions, but not pessimistic. Most of the CEOs and CFOs are saying that they can live through this situation with the basic belief that things in the second half are going to get a lot better. If that's the way it works out, then we're all good. If not, we're going to have to be repriced.
Well, you were talking about the high prices, and I was looking at, like Netflix, a lot of the IT communications. I mean, their PE levels are pretty eye-popping, compared to their earnings. So what do you see in the industries in terms of pricing? I mean, when we look at it across the board, they look very expensive, but are there certain industries that are a little more outlandish than others?
Yes, IT still is. If you like the stock at 380, you love it at 180. It's not really a justification. Again, we're looking beyond the first half at this point because there's more pressures coming in. Margins are still high. We learned one thing from Q4, that companies were still able to pass through a lot of their higher costs. And sales are expected to be a fourth quarter high, not by a lot, by 1.2%, but still be a record for Q4. That the expectation is that we will not be able to continue pushing that through in the first half, which will reduce margins more and take those earnings farther down. Again, we were selling on 2023 and 2024 earnings going forward, and there's a lot of unknowns there. At this point in time. But even technology, at least there's earnings there, and there is cash flow for a lot of these companies as compared to the late 1990s and early 2000s when we had the declines there where everything was negative numbers.
Yeah, there was a lot of cash negative in the dot-com recession. So let's talk a little bit more about, high interest rates also make it more difficult as well as more expensive to borrow. So are you seeing any industries where debt and leverage may be an issue and they may have to raise money at a higher cost?
Yeah, I'll start with the higher end and then move down into the sectors or so. On a higher level, interest expense, at least through the third quarter, because that's the only data we have so far, we haven't completed Q4 yet, was the highest since 2009. Okay, but it was still 48% less than 2007. So the numbers are higher, okay, and it's costing more, but still, when you look at the third quarter, again, what we have full numbers for, it was costing on a dollar average basis for companies in the S&P 500 about 3.4% interest. That is definitely going up. 3.4 may seem like a nice number now, but again, that's over 4 months ago. Rates have gone up. That's going to be an issue with some companies who can't get the financing. And the lower you go down, typically in the market value, the more difficulty. So you get small caps, which don't have as many resources as compared to a big cap. Could still go to Germany if they want to borrow money at a lower rate, because they're internationals and they have different kind of assets and relationships, as well as better access to the public markets. Technology, ironically, uses buybacks as part of their salaries, and they don't borrow as much for their general expenses. So they're a little bit insulated to that, ironically, unless they want to use it for buybacks. utilities and some banks are totally separate, but utilities and real estate companies very susceptible to interest expense, not just on their income and flow of funds, but also on their dividends. On their,
Right.
I opened with commentary on downtown being empty. I can't get a bran muffin from a wagon, and their floors that are totally empty. I mean, I go in and out of other houses, and they literally have floors totally empty. Not that they can't sublease them; there's just no market for them. And that is not just the major cities, which I visited and I've seen, but then you get into the real estate situation of individual homes, which is still a lot of demand and higher prices, and interest rates may have edged a tick down, and we think that it's going to go farther down, later in the year. It's still high, historically high. No, it's not double digit numbers the way it used to be from Jimmy Carter times, but it is a lot higher than it was a year and a half, 2 years ago, and that's definitely putting pressure on the real estate market.
Yeah, and I mean, we have to talk a little bit about banks, because if you look at a mortgage bank sector as an example, I mean, they're really getting hit. How do banks typically fare if the market weakens? And will this one be different because everybody's being so optimistic of the second half of 2023?
Optimism is nice, but when the Fed does that test, they're pessimistic on there, so that hurts. And I might note, by the way, up right through Q4 reporting, banks have pulled back on buybacks significantly. And the reasoning here appears to be, at least the general consensus, is that they're protecting their dividends. Dividends beat out buybacks, because they're worried about the next Fed test. But as far as the market, if we start to get a difficulty in the mortgage market itself, where you get defaults on there, the good news is that prices are still high enough that if the banks have to foreclose, they should get their money back. The difficulty here is the lower amount of mortgage rates. You may not have a high percentage in there, so you could have difficulties. We saw in the fourth quarter a few banks add to their reserves for that, but in general, they have not added that much yet. But if we get more pressure across the housing market, in other words, that the buying is not there, the bidding up of the prices, even if it's a lower number of houses, that'll impact their numbers significantly.
Okay, so let's dive into the real estate. And I know there's many forms that real estate can take. We have on the good end, you have storage, warehouses, and perhaps data centers. And on the other end, you have a lot of empty office buildings. So what do you see for real estate this year, especially with higher interest rates, and even in the housing market where, unaffordability is a big deal?
My biggest concern, and therefore the largest opportunity, obviously, is in offices, which in major cities have been hurt. Yes, all those companies are still paying their rent, especially downtown. But as it comes up, 20 floors become 15 floors, become 12 floors. Especially with fewer people going into the offices now. So that, I think, is where we're going to see the most pressure on. Does it give you the most opportunity? Definitely, risk reward scenarios. A lot of areas are looking to repopulate the buildings, potentially with families, homes on there. We saw that after 9/11 in New York. We've seen that in cities that have redeveloped themselves, from Michigan all the way into Pittsburgh. So they have definitely going to go through some kind of change there. But on the short run, it's definitely on the downside. And prices, to some degree, are showing that in there. So the dividend payout, which on there is expected to potentially decline short run. But again, it depends how many years it takes to redeploy the assets of the offices, malls, as depending again where they are,
Yeah.
outside of major cities or standalones. The difficulty there also exists with the increased web that we all saw during COVID, where you went and you ordered everything online. That started to decline, but it is still significantly higher than it was 2019. So
Yeah.
the actual shows, the amusing stats, at least that come through on a lot of the stores, the retail stores and malls, is revenge shopping. As compared to revenge travel. People
Oh,
are hooked so much that you're getting to some degree a much higher boost short term. But what happens in another 6 months? Out? Does it continue to see those large numbers? So again, here you do have a high risk reward scenario. You have assets, and if you have the ability to hold on to that and develop that area into something else, it's a nice potential. However, the bottom line is that short term cash flow is not going to be what you want it to be.
right. Okay, so let's talk real world because I know you have kids. And by the way, it doesn't look like you're in the office today, Harold.
I am not. It got a little bit cold up in the city. So I am right now down in Florida for a little bit
Oh,
while more. And if you and I get into a little bit of a disagreement, I am going to take my camera and point it out the window because I am literally on the beach. And if
I love it. Okay,
but
so your daughter had 40 stocks and you remind her
had
that had, right?
yeah,
Then you
yeah.
remind her that analysts, don't babysit 40 kids at the same time. And what other words of wisdom are look, the truth is, Gen Z and millennials, the millennials, yes. Gen Z, no, they haven't seen really a downturn.
Right.
Millennials might have, with their parents. But we have now the two largest cohorts coming into the market, ready to invest, wanting to earn money while you sleep, and having, maybe even a foggy memory of the downturn, having broker salesmen saying, hey, look at all the money that was made for the past 12 years.
I,
What what
and they
advice
get
do you give?
emojis. And they get emojis. They won. They didn't increase their portfolio. It didn't decline in value. They won. The bottom line here is too. Let me first answer on a personal item. I'm glad that my two kids lost a few dollars. It is a great lesson to learn at
Yeah,
that age. They're in their 20s. They had a few dollars. They lost it. As compared to you losing the rent, losing your retirement
yeah,
money, your savings. So I think it's good, but it also speaks to that all these kids are now familiar to some degree, good and bad, with the market. That is your future investors going forward,
yeah,
not just through their 401ks or company accounts, but literally on their cell phone making trades. So that does speak to them. Do they need to be educated? We probably all do, even at our age still. Uh,
yeah.
and eventually it'll come, and it'll come at a cost, but it does speak to investing on an individual basis and where they'll be putting their monies. Most of them, from what I'm reading, actually did actual issues as compared to when you get older. There's a higher tendency to go more into a fund, an index, or
Right.
a mutual, something like that. But they're definitely stock pickers. They need to do a better job, but it's very positive for the brokerage industry.
Yeah, and it's pretty difficult to be a stock picker in a recession. Don't you?
Most we do a quarterly survey, and about 85% of the active managers don't beat the index. It's hard to beat an index, especially in a down year.
Yeah, yeah, and especially if you add in those fees, a lot of them are at best shadowing the index, and then they're under due to the fees, right?
Uh, I'll give you a stat on that. About a little over 17% of the S&P 500 is indexed, meaning if we put an issue in or out, S&P does.
Yeah,
That 17% that issue has to be purchased by people who are licensed. Okay, they have something called emulators, which we believe is more than the 17%. These are fund managers, investors that go in and buy that 70% of the S&P 500. directly through instruments, agreements, however they get 70%. And then
Yeah.
with a portfolio that might be a single digit, less than 10 issues, try to beat it to cover that cost that you're saying. We call it a tracking area because the index doesn't have any cost. If you're an actual trader, you have costs. So we believe that more than that 17%, emulate the index and attempt to beat it with a few stocks on the side.
Interesting. Interesting. All right. Well, I'm going to give you the last word. As always, thank you so much for, all the data geeks out there that love the data statistics information. Where can they learn more and where can they get educated more and have access to your wisdom?
Wisdom or not wisdom, there are files that I put up on the web, spglobal.com. You can go to spdji.com and just search S&P 500, and you'll start to get a lot of files and the additional data. Those are Excel files, they're work files, earnings, dividends, issue level data with tickers. They're meant to be used. They don't look pretty. You're the one who has to make them look pretty. I don't make them look pretty. They're useful. If it's a date, it's a date. If it's a number, it's a number. And again, the tickers are in there so you could extract them and use it in cumulative data. There's a lot of files out there, and it gives you some instruments and some data that you can use, that's methodology based.
Perfect. And
that's a good place.
You're probably on social too, right?
I am H Silverb. At Twitter. Stands for Howard Silverblatt. But when we started it, we didn't have great guidance on what we could and couldn't do. So we used H Silverb and figured we could always walk away from it if it didn't work out.
Okay. Well, we'll put links in there so people can follow you and access you. As you can see, Howard tells it like it is, tells you like he sees it, and has some pretty bad dad jokes to boot. All right, Howard, any last word before we sign off?
No, just, but if you're investing, keep an eye on what you're doing, know your tolerance level. Everybody wants to gain. Losing is difficult. So do not put anything on the table that you can't walk away from.
There you go. That's good words of wisdom. So thanks again for joining me. As you know, I do interviews with a lot of folks that we really want to have their access to their wisdom. Be sure to follow me on social. I'm Natalie Pace on Instagram and Natalie Pace on a lot of the other places. So you can also find me on Facebook, the ABCs of Money. Go to nataliepace.com and it's easy to follow me on social because you just click on the social media icons and there you go. So thanks again for joining me today. And if you are interested in learning the ABCs of money and the life math that we all should have received in high school, and to also learn our easy as a pie chart nest egg strategies that actually earned gains in the dot-com and the Great Recession. So they are very efficacious at protecting your wealth. Join me at my online retreat. It's a financial freedom retreat. It's April 22nd through 24th. Online, you can attend in your pajamas in your living room. It will transform your life. We also talk about what's safe, so it's a complete money makeover. And we are having early bird pricing through tomorrow only. So early bird pricing ends February 8th. You're going to save at least a couple $100. If you're bringing someone with you, you're going to save a boatload more because we incentivize both couples to come together, but family members, parents with their teens. So go to nataliepace.com, scroll down, you'll find our April retreat information, and be sure to register by tomorrow, February 8th, to get the best price. You can call us at 310-430-2397. You can email us at info@nataliepace.com. And thank you again for joining me today.